financing in the life science ecosystem and valuation, investor sentiment, and market trends. That's what we're here to talk about today. And with me on stage, from the stage right, I have Anthony Leach, Head of Sector Healthcare at Pareto Securities. Welcome. And then we have Olof Åberg, yeah. Healthcare ECM at Carnegie. And last but not least, Bergström, Project Leaders Life Science at Erik Penser Bank. I wouldn't say anything about that, the fact that you are representing the same company today. You weren't yesterday, but that's okay. So perhaps just a short presentation round to tell us a little bit about your specific role in your respective organizations. And it would be great also to hear a little bit about what kind of sweet spot you have in terms of financing companies, transaction sizes, and so on. Could start with you, Anthony.
Yeah, great. So Anthony Leach, Head of Healthcare at Pareto. I've been there for, I've been at Pareto for 9.5 years and had this role for, close to 5. My job is sourcing, structuring, and then closing healthcare transactions, basically. Our kind of sweet spot on biotech is, I'd say, phase 2. They have some sort of proof of concept on the efficacy side. Earlier than that, we find it quite tough. On the medtech side, it can be, at a minimum a CE mark, although that's maybe not saying much. But nowadays, we're looking at slightly more mature companies. On the medtech side, some kind of sales is good, and a sort of, some kind of vision of where they're actually going to become sort of cash flow positive.
I thought you were going to say some kind of vision of revenue, but
yeah.
Thank you very much. Olof, what about you?
Yes, so Olof Isacsson Åberg, part of the equity capital markets team at Carnegie, focusing on healthcare. So essentially working as a link between the investment banking healthcare team and the market and all the market participants, as investors, sales, research, and all external parties, essentially. Been with Carnegie for just about 2 years. Previous to that, I was with DNB in a similar role, and then at Pareto even earlier, so former colleague of Anthony. At Carnegie, well, we work basically with the same segment as Pareto does to a large extent within the life science sector. Similarly, we've seen a shift towards mature companies, but we're working both with the private sector and the public companies that are listed already.
Great. You were a colleague with Anthony, and now you're a colleague with Don.
Yeah, exactly.
So Don, what about you?
Yes, Don Bergström, Senior Project Leader at Erik Penser Bank. That was acquired by Carnegie yesterday, and it will be great joining. But we have a different focus. We are more smaller companies, so our target niche is the First North segment. And we work in a pretty fast-paced organization, flat, so we work with the whole project management and also with securing the transaction. So everything from working in the projects and the securing the capital.
Thank you very much. So securing the transactions and bringing in capital is a key component of what all of you do, and in that then that involves tight dialogue with investors. So how would you say that investors, given the challenging market conditions, how have they adjusted to all these new realities that we face today, would you say? You can start with you, Don.
Yeah, basically we can see that they have started looking a little bit more inwards. They are looking at what eggs do they already have in their baskets, what do they need to protect those eggs. Is there any eggs that they should specifically focus on, or maybe some that they can't focus on? Is there room to add more eggs in the basket? It's the big question for them right now. And also we see that they limit the risk that they are taking. They are decreasing somewhat the size they are taking in new bets. So we see that they have adjusted in those ways.
Is that something you have seen along your investor base as well?
I very much agree with that summary. And I mean, it feels like the key theme with investors now is just an increasing risk aversion that they're looking at. I mean, where can we where do we have risk of, downturns in our portfolios? And another focus is really the liquidity, both liquidity in the stocks, but also liquidity in their own portfolios, as we're coming from a period of significant inflows to essentially all public funds. Now that capital is partly flowing back out of them, so they need to manage both the cash that they have at hand to support the companies that they already own, but also look at, okay, which companies have a liquid trading and which do not, and then try to manage risk in that regard.
So risk management and also protecting what you already have, a general theme. Anthony, would you say, we talked about earlier with another panel here about also this market being perhaps then, giving birth to some opportunities. Do you see any of that sentiment within your investor base?
Well, I'd say the investor base is, adjusted, as you said, and that's basically by allocating less money to life science. I think it's halved over the last few years, the percentage of AUM allocated to healthcare, or medtech and biotech specifically. So that's their adjustment, and we're trying to adjust accordingly and finding new structures. There's certain types of debt instruments that work for some companies, but in the end, it's tough. It's for the investors that want to take risks now. As long as they're doing a good job at picking their companies, they're going to be getting stuff at a sort of bargain price compared to what they were doing a few years ago. And if you look at the specialist money that's flowed in, first half year to date, I think that they were on par in fundraising as they were maybe all of last year, and also pre-pandemic levels. So the smart money is building up the sort of coffers, and they're going to take advantages of this, and then I guess maybe the generalists come back for the next bubble.
Speaking of bubbles, then IPO activity, we've seen record levels in the past few years, and now that IPO window is firmly shut, you could argue. And how does that affect the investor view on the life science sector? You think the fact that IPO as a possible exit is virtually non-existent right now, is that something you have reflected on, Don?
Yeah, we can basically see that when we are talking with investors, there are a number of them that are saying that they are having positions in several companies that were supposed to be in an IPO. So they see maybe limited opportunities right now to add an extra company to that pipeline. So they are structuring their portfolios, and I think we would need to see some more IPOs for some investors to start building up their positions in that segment again.
Mm. And is that the signs of any such activity sort of reigniting and coming back to life? Do you think that, are there any signs pointing to that direction? What would you say, Olof, about that?
I think when we got back after the summer holidays, I think we were increasingly optimistic that we would see some increased activity in H2. And then markets unfortunately developed in a way throughout September that almost put a complete stop to those ambitions. There's been some companies in both in Sweden and the Nordics and in Europe that have tried to come to market, but it's been with quite mixed results. We had Usta this last week that has been trading just above issue price, so that's a positive sign. But if we're looking at a broader perspective, many of the IPOs that we've seen in Europe have been pulled over the last few weeks just ahead of intended first day of trading. So it's looking at IPOs as a product. We're still lacking the confidence from investors that it will work out the way it's intended to do.
And Anthony, is that a view that you share in general?
Yeah, the IPO market is not dead; it's just in a coma. So we're going to have to wait a little bit, and things turn around, and they turn around usually faster than anybody expects them to. Was it beginning of 2020 when we had COVID? Everybody thought, okay, game over. Then just before the summer, everything sort of ripped up again. So I think the same will happen this time, but I think this might take a little bit longer.
I think just to add to that, I mean, I think the key thing with IPOs is that you have to have the market fundamentals, and those have been improving somewhat, but then you also have to have the confidence in IPOs as a product, because that's essentially IPOs is an attractive way, or intended to be an attractive way for investors to add alpha to their portfolios, essentially a way to beat the market in that regard. And if the general sentiment and consensus is that IPOs won't trade well, then it will be difficult to get them done, because then the product isn't working. So that's really what we need to see.
And also in a difficult market, it is possible to do IPOs even if the market is difficult, if you have the right type of companies. Like last year, it was also a rough market. We did an IPO after the invasion of Ukraine. Promimic, a nice life science company with nano coating of implants, and that was possible to do with strong support from current shareholders and an attractive niche. So it is possible to do IPOs, but it is tough.
And I think that's the key. I mean, strong support from current shareholders. I mean, for an IPO to be successful in Sweden, you have to have the Swedish institutions behind you, and if they'll get comfort from a sort of current strong shareholder base. I mean, nobody can rely on just getting the foreign money to make an IPO happen. So,
needing to have then investor confidence in, like you said, IPO as a product, as a attractive offer then. And speaking of it being in a coma right now, I mean, if you have a patient in coma, you would be staring at the EKG screen, hoping for a little blip somewhere. Maybe not EKG, maybe it's EEG, I don't know. You tell me. Anyway, you'll be looking for that little blip that's a sign of life, basically. And so if we don't have that now, what should investors in general be looking for? What kind of signs in the market should we look at? Is it enough if the interest rate goes down, for example?
I mean, at the moment we're in an environment that there's still quite few directed issues happening for taking in new money. Most of it is, I guess, still rights issues. When that starts to go back to more sort of directed issues, private placements, then that shows that market is functioning, and then the IPOs will probably follow after that.
And what will make that market function? I mean, is it investors seeing that they will make some kind of return fairly easily? Or?
I mean, I think it's up to the companies to show some pretty fantastic data.
You were going to add something, Olof?
Yeah, I mean, just on the what signs are we looking for? I mean, it's the important thing to remember with IPOs is that it's one reason why it's such a high risk offering type is that, I mean, the market exposure you have extends for almost a month from intention to float to first day of trading, and then you ideally want to launch the IPO in a calm market. So one very vital factor for investors and companies to look at is the expected volatility in the market, and that's something that we're monitoring closely. And that's, I mean, the magical level in a historical perspective has been that should be below 20, and now we've actually seen it below 20 for much of H2. Now it's a bit above again, but it's at least a positive sign that it's starting to trend below.
Yeah, stability is really the key, because if you have stability, then you can actually count on things, and if you can count on things, then you can make a good business decision. So I believe that stability in some sort is a key factor.
More calculated, easily calculated risk then. So IPO is one thing, but we already have quite a few listed companies, especially in life science in Sweden and on the Swedish markets. And well, it's safe to say that quite a few of them will need to raise capital within the next 12 to 18 months, some even sooner, from a pretty acute state of mind, so to speak. What can we expect? There are so many companies that need funding, and if the investor sentiment is very cool, what can we expect then to happen, you think? Do you think, Don?
Well, in the case of raising capital right now, it's key factor as well as in the IPO that we mentioned, that you need to have the support of your current shareholders. Because what we see is that if you have some lead investors to follow, then you're actually you're getting more traction with the other investors that you need to secure the full funding. Because in many cases you need to reach a minimum amount of funding in this typical sector in case to fund a study, you need to fully fund it. So make sure to be involve your current shareholders, have them informed of your progress, and don't just approach them when it's time to beg for more money. So keep them involved and informed.
That sounds like good advice, and we're all here to help with that. Olof, you're going to add something.
Yeah, no, I was just about to say that also what to expect is that it's going to be actually probably a lot of quite painful capital raisings, and it's just the reality of it. So it's best to try to plan for all scenarios from the get-go. I mean, even if you're targeting a directed issue to begin with, there's no harm in having a plan B or plan C, which is other financing alternatives, and know when to switch from plan A to plan B to plan C.
And we've also earlier touched upon that with the alternative financing alternatives. Can you give any examples of what you have been seeing lately in that respect?
I think it's very much in line with what was mentioned on the previous panel discussion, that we're seeing, for example, we're seeing an increasing share of rights issues, and in the rights issues we're seeing more and more transactions that are being structured with a combined share and warrant element, just to both to make it more attractive for investors, but also to build in the flexibility that we're giving you some money now, and then when you're proving yourself, we can exercise the warrants and continue to fund you at that stage. And then also, we discussed convertibles were discussed earlier, and that's also something that we see more and more, and even some companies that are looking more into private credit funds for an alternative source of capital.
And then seeing as like you said, you need the support of your existing shareholder base, and you could also, like I think we touched upon that also, with more tranched transactions, or picking capital in tranches, basically, with warrants. But then could that not be also sort of a downward spiral, that you make a rights issue and you include warrants, and then you really have the knife to
It depends where you're striking the warrants. I mean, if you do a rights issue and attach warrants to them, you can either strike the warrants out at the same price as the rights issue, which is already a massive discount anyway. Then you don't get the downward spiral, right? Because there you have your floor. But if you're doing a sort of 30% discount to some price in the future, then there's no. I mean, why is anybody going to hold on to the share? They know they're going to be able to buy it a lot cheaper later on.
So there are a lot of moving parts, and that's why companies should talk to experts when they raise money. I got my papers in order here, and yeah, we touched about are there any positive signs, but what are the expectations then from the companies getting out there now raising capital? What are the expectations on valuations, and how does those expectations align with investors' view on valuations, would you say?
Well, actually, now after the summer, we feel that the companies that are at least the listed companies, they have come to a much closer approach to where the investors have been doing, where they feel that the valuations are. So we actually see a little bit easier on agreeing on the valuation of the companies right now. So in the listed market, we see that, but that is also because you have a market price that is adjusting every day. And so in the First North segment, we actually see that it's a little bit easier to meet investors and companies at the moment.
And if you are doing transactions in the higher transaction size level, is that also true? Is it easier now to see a good balance there between expectations from companies and investors alike?
I mean, well, in the listed company, it's quite easy. They have a share price, so that's where the fair value is at the moment. That's where investors are pricing it.
Hard to argue with.
Yeah, but I mean, it's simple. I don't usually get into too many sort of valuation discussions with companies. I basically tell them that this is how it's going to work, and this is the pricing, and you know.
But wouldn't the discussions then rather be about discounts rather than the actual valuation?
Yeah, I mean, the discount is particularly on rights issues, whether it's a 35% discount to your TERP or it's a 40% discount. But the balances shift over to the underwriters of the transactions, right? So they're the ones that have the money. They're the ones that can underwrite the deals. They're asking for bigger discounts. But you know, realistic, you're looking somewhere like 40% discount to TERP nowadays. Underwriting fees, double digit, where they would probably be maybe 7-8% in the good old days. But it's just, you have to be realistic with the companies you're working with.
Yeah. Do you want to add something?
Yeah, no, I was just about to add a bit on the kind of the private market perspective, and I think those discussions are also easier today than they were a year or a year and a half ago. It's easy to think that if you're a private company, you're somewhat protected from the moves in the public market, but many investors invest across both public and private asset classes, so they will of course mark their valuations towards what's happening in the public market, and feels like more people are aware of that today than they may perhaps were a year and a half ago.
And now, I mean, in biotech, you see the sort of more traditional private market guys, they've actually started to look at public markets as well and taking that into their funds. And that's, I guess, mostly because prices have come down a lot faster there than they did in the private markets.
So they see the opportunity there. Yeah. So, but Anthony, you were touching upon the fact that underwriter fees are higher now, and well, basically cost of capital, raising capital, and that's also true, I think, for guarantors, using guarantors. Is using guarantors in a market like this, is it even? Should you do it or should you not do it? What do you say? I
mean, usually when a company comes to me, they actually need the money. It's not just a nice to have, it's a need to have. So if there's 100 million that they need, then then you're not going to get any investors in if the money's not secured. If it costs 100 million to do the project, that's the minimum amount that you need to get in. And then you have to adjust the structure accordingly to make sure that they have the money to get to the next milestone. Otherwise, everybody's kind of wasting their time. Mm.
Is that your reflection as well, that you just do what you have to do, basically?
Yeah, I mean, especially in this sector, when it's so clear that the money you're raising is expected to take you to this and that milestone or finance this and that study, then it becomes pretty crystal clear that this is the amount you need, and then it's not a question of how much do we want to push sales, for example, because then you can adjust based on how much you raise. But when it's a fixed amount, it's a fixed amount. So then the guarantors, you should think about them as an insurance, basically. And now the prices of that insurance has increased.
Yes, and you were also mentioning the fact that you need the support of your existing shareholder base. But if you can't muster that support, then you're really in the hands of guarantors, for example. Is that correct?
Yeah, that's correct. And in the case of securing those deals, it's as we heard from my colleagues here, that you actually need to fund the specific amount that is needed to conduct the studies and so on. And then it's often, the last krona that comes in, that is the most important krona, and it will reflect on the price to secure the transaction. And as Anthony said here, we see double digits for sure. Seen it for the last couple of years. It's around in the smaller niche segments. It's around 12%, I would say. I think we have gone up to 14, the highest, but we also see transactions that are up to 15-20%.
And I think these comments and this discussion around the importance of shareholders just kind of reinforces what Peter said in the the earlier panel discussion about how important it is to already at an early stage think about what kind of investors you get in, and not only how much are they investing and at what valuation, and try to really because now in these times it becomes crystal clear that it makes all the difference in the world who are funding you.
So would you say that the market climate, investment willingness, if you will, and all the signs that are now pointing towards continued, perhaps a little tough time, what do you in general expect for the Swedish life science market, say in 3 years' time? Do you think it's gonna become like a quick turnaround at some point when things start to lighten up, or do you think it's gonna be a long slowly downward spiral towards something bad? What do you think, Don?
Well, how long these market circumstances is going to last, it's very hard to answer, but it can definitely become worse as it is. It's the geopolitical situation is it's very disturbing at the moment, and it might be it might be a long period, it might be a shorter period, but it can get a little bit worse. But at the same time, we see that there's a lot of companies that their valuations had come down very much. So we see that there is already some investors that are seeing that, okay, I might be in the negative returns in the short term, but this is an attractive level long term. So in 3 years, then I would say that we definitely have bounced up from here.
You share that view?
Yeah, I do, and I was just about to say that. I mean, given that interest rates have been the key theme over the last 2 years, and really what's been driving markets to a large extent, I think that as soon as we're seeing interest rates kind of leveling out, and we know that we have seen the peak or past the peak, then we will start to see improvements. But then we won't go to zero interest rates in a week, but that will be a gradual process. So hopefully the turn isn't too far away, and then we will start to see a gradual increase as we go along.
You share that view?
Yeah, more or less. I mean, I don't think things are going to turn around super quickly. I hope in 3 years' time we're back to some kind of normality. Otherwise, things will be pretty depressing. But I think the companies that are waiting for better times before they pull the trigger and sort out their financing, they're just going to get into an even worse position.
That could be could be a scary chicken race, so to speak. Well, given things are what they are right now, and that the outlook is what it is, what would be your respective key advice then to companies that are in the situation that they need to get capital within the next 12 months, for example? I see that we have about 2 minutes left, so if you use 40 seconds each, that should do the trick. What about you, Don?
Okay. Number one advice would be not wait too long until you contact a financial advisor, because the runway to actually get the financing secured, it's much longer than it was 2 years ago. So there is much more work needed to be done now to secure the funding necessary. So be sure to be out in good time, because it's also reflected. The investors can see your balance sheet, and the sooner you're out and make sure it looks all right before it gets really bad, the better.
And as you follow Dan's recommendation to engage the advisor early, I mean, dare to have the kind of the difficult conversation early on as well. I mean, what do we do if the intended plan fails, and when do we need to switch over to plan B?
Echo and all that. Also spend a lot of time looking at your projects and make sure you have a plan to fund the stuff that is a need to have, that's going to sort of get you to your milestones quickly, and have good news flow, and the nice to have projects don't matter any longer. So
contact a financial advisor sooner rather than later. That's going to be possible in a little while when we have the next break, I guess. You can meet them out here. I'd like to thank you very much for taking the time and for sharing your insights today. Thank you.
Thank you.
Thank you very much.